Welcome to the November version of the IFTN Education Credits and Training session. Thank you all for joining us today. A reminder that the session is being recorded so that we can post this to the webpage at a later time for viewing and those types of things. So great to have you along today. For the integrity of the program, if everyone could remember to turn on their cameras so that we know you participated for the majority of the session, that would be great. And then I will send out the link in the chat so that you can apply for your credit hours or credit points through that link at the end of the session. So those of you that are on the phone, if you could send me a private chat to let me know who you are. And then at the end, also, please send me an email so that I can email you the link to the credit hour reporting link. So if you're on the phone, please take that extra step to make sure that you get the link if you can't see it here. With that, I think I will turn it over to Brandon. And Brandon, if you would introduce yourself and take her away, we'll get started there. Thank you.
Excellent. Well, thank you, Heather. A good day, everybody. Not sure what time zone everybody's in, so it's either morning or afternoon, but I hope everybody is enjoying the week so far. My name is Brandon Dirkschneider. I am a certified financial planner. I am a farm succession coordinator, currently sit on the board. And this morning, we're going to talk about some of my experiences with clients in the life insurance questions they have when it comes to farm succession planning or continuity planning, and some of the pitfalls that they've experienced in some of this. So if I can get, this is my wonderful disclosure that I'm required to make and make sure everybody from a tax or legal profession gets their own professional advice from their own independent sources. But we're going to go over today what seemingly can be an innocent decision is about regarding life insurance may have unattended costly consequences. And that's pretty interesting when you think about, something as simple as life insurance. When it comes to farm succession planning, what are some of the pitfalls or what are some of the things that can happen that causes some unnecessary tax consequences to our farm families? So when we take a look at what the agenda, some of the things that we're going to talk about today, we're going to talk about simply as titling mistakes and what consequences those titling mistakes on life insurance policies have happened. We're going to talk about what estate planning mistakes can happen with regards to life insurance and a farm succession plan. And then we're going to talk about some of the aspects of policy management, which some people aren't really so sure about when it comes to managing an asset such as life insurance itself. So when we talk about one of the most common mistakes that I see with most farm families when it talks about succession planning is really the structure of ownership. And this structure of ownership causes a huge issue because it's called what the industry would call as an unholy trinity. And the reason for that is because when you have three different parties on a life insurance policy, it can create a substantial tax issue. So we were dealing with the farm family where the mother and father, the patriarch and matriarch of the farm, were the insureds on a second to die policy. And in this situation, they were really trying to figure out a way how to equalize the assets from the farm family from one generation, from their children. So they had a son who was back in the farming operation who they wanted to make sure inherited most of the farm ground and equipment. And they were sold this life insurance policy where they named their daughters the beneficiaries, which they would receive the death benefit to help equalize the estate. But where their advisors went wrong is they made the son the owner of the life insurance policy. Mom and dad were the insureds, and the beneficiaries named as the two daughters. Well, in the Internal Revenue Service's eyes, they view that as a gift, that the brother is actually making a gift to his sisters because he's the actual owner of the policy. Even though mom and dad were making the premium payments, the brother is making a gift because he owns the policy to his two daughters. Now, that is pretty substantial because that means he's either got to pay gift tax on the death benefit that was paid out to his sisters, or he has to use a portion of his federal estate tax exemption. And in this case, that policy was a $5 million second to die policy. So that was $5 million of an exemption that he could not use to pass the farm down to his two sons, who were also involved in the operation. Well, today that federal estate tax exemption is just over $12 million per person. So farm family can pass down $24 million to the next generation without causing a substantial issue. But where this becomes an important issue is on January 1st of 2026, that a federal estate tax exemption is going to drop down to $5 million per person. They are saying it's going to be indexed for inflation. So even if that's the case, let's say it's inflated to $7 or $8 million for a husband and wife, that's 14 to $16 million they can pass down the next generation. $5 million is a good chunk of that. So you have to be careful on how you structure the ownership and the beneficiaries on those policies to make sure you're not accidentally causing a substantial gift or using a portion of that person's exemption. So in this case, what we've done to be able to fix some of those is, okay, how can we, make sure that gift doesn't happen? Well, in this case, what we ended up doing in this situation is we actually we switched the owner back to mom and dad. Mom and dad were actually the owners, and switched that back. And then they were the premium payers. And that way the brother did not make a gift back. And we'll talk about some more of that. But ultimately, what is it? The solution is, if the insured is not the owner, that's where we want to try to make sure that we're utilizing a trust, and that trust could be the owner and the beneficiary. And most of the time that should be held in what's called an irrevocable life insurance trust. So it's held outside of the estate. So it's not subject to federal estate tax, let alone income taxes. In that case, if the trust is the owner and the trust is the beneficiary, when mom and dad passed away, they could have made their two daughters the beneficiaries of the trust to help equalize that estate, and avoided that situation. So you really need to be careful about these third-party ownerships. The other aspect of that too, with the benefit of the trust, if it's owned by a trust, then it's also creditor protected, which means that in the event that the son did own that policy, if he would have been sued, if he would have been caught up in a divorce, or if he would have had some financial issues in a bankruptcy, that's an asset that was in his name. That's an asset that potentially could have been lost. So we really don't want to lose control over that policy. So again, utilizing that trust, where the trust is the owner and the beneficiary of that policy, that really helps give it creditor protection and keeps it free again from the federal estate tax, but from divorce, from bankruptcy, from lawsuits of that nature, and making sure that death benefit is there for the other non-active children to equalize that estate. The other thing that we need to make sure that we're paying attention to in that situation is making sure that if the insured is paying the premiums and it is held into a trust, that we need to make sure that that individual is filing the annual crummy letters to make sure that that policy is not pulled back into the estate. And we'll talk more about that as well. But that's one of the big things that we see, is just the incorrect titling and ownership structure of life insurance policies that cause unnecessary taxes. The other aspect of this is it does even include when I talk about an entity ownership. So a lot of our farm families today, they're creating LLCs, or maybe they have family limited partnerships or an S corporation. Well, you're going to run into the same issue if you have three different people on a life policy. So in this case, if the owner is the corporation, the insured is the business owner, the owner of that LLC, but then they go down and they name their spouse or they name another family member as the beneficiary. You have the potential to create a taxable death benefit because you have the three different owners. So how do we get around this? There are ways where you can get around this, because when you're looking at that aspect, if you're wanting to try to provide an additional benefit for a spouse or for an employee that works on the farm, but the company is the owner of the life insurance policy, You simply have to go in and do a split dollar of the death benefit. And what that means is you can allow an employee to endorse a portion of the death benefit. And if you endorse a portion of that death benefit, that employee simply has to pay tax on the economic benefit for being able to name a beneficiary on a policy that's owned by the corporation. And we see this a lot, whether it's farm families, non-farm families. That's an additional employee benefit to try to give that employee a simple thank you for their years of service. But the big thing that is there is having that different owner, different insured, and a different beneficiary. If there are three different parties, whether a business is involved or if it's individuals, that's going to cause adverse tax consequences, and that death benefit will not be tax-free. So very important decisions to look at when you're structuring a life insurance policy itself. So again, when we talk about the solutions of the corporate ownership, like I said, it's more of an executive benefit, making sure that employees paying the tax on the economic benefit through via a split dollar agreement. And we can talk more about that when we get in questions and answers, if you guys have any experience with that. The other big one that we see is no successor owner is named. And this gets into play for a lot of farm families, because you may have siblings who own life insurance policy on one another as a part of a buy-sell agreement or to fund a buy-sell agreement. But in that situation, let's say, for example, you have two brothers and they own a policy on each other, okay? So why would they own a policy on each other? Well, the buy-sell agreement may state that if I passed away, my brother inherits the death benefit proceeds income tax free. My wife has to sell her assets from that farm. And because of the tax laws today, she got to step up in basis on those assets at my death. She gets my brother uses the life insurance proceeds to buy my wife out. There's no taxes due in that transaction. But what's interesting is my brother's still alive, that I owned a policy on him. So what happens to that policy, especially if I don't name a successor owner? Well, then it becomes a part of my estate. Well, my brother's really not going to want my wife to own a policy on him when she's essentially been bought out. So then we talk about, okay, how do we name a successor owner? And we can name a successor owner. Maybe it's my brother, maybe it's the farm entity, maybe it's something else, that make sure that that policy continues to serve a purpose in the event that it's no longer needed to fund, i.e. a buy-sell agreement. Where else do we see this? We see this a lot where maybe the mother or the father own a life insurance policy on one another. So as spouses, I may own a policy on my wife, or my wife may own a policy on me. But once one of them passes away, what happens to that other policy that we owned? Does that become a part of the estate and potentially create a federal estate tax? Should that be passed down to our kids? What purpose does it serve? Or can it be helped to use to equalize an estate? So the big solution, the easy solution, is just make sure we have a successor owner named in those situations. Who's that policy going to be transferred down to? And the transfer of ownership can also cause an adverse tax consequence, because there's portions in the Internal Revenue Code called transfer for value issues. And we're going to talk about those transfer for value issues and some of the things that you need to be concerned about. But if you do name a successor owner and there is transfer for value issues, again, there could be potential taxes, there could be potential income tax due on that death benefit. We're going to talk about that as well. Second, we're going to talk about naming your beneficiaries on a life insurance policy. So most of the time when a policy is established, if the individual is unsure exactly, or they haven't completed their estate planning process, maybe they'll just name the beneficiary payable to the estate. Well, when a beneficiary predeceases, the policy gets paid to that estate, it could be subject to probate. and subject to probate could delay in that death benefit being utilized to pay, whether it's inheritance tax, federal estate taxes, reduced debt or liabilities, or to buy out heirs. So we really want to avoid having the estate named as a beneficiary, because it also could be subject to the claims and creditors of that estate, where if we're trying to facilitate a buyout or an equalization, we really want to make sure that we have the named beneficiary. Again, this is where trusts are a very powerful tool, because it's held outside and it's not dictated to some of those rules and regulations. So again, what are we going to do? We need to make sure that we're updating our beneficiaries. Those beneficiaries are applicable to the farm succession plan. And we also name a contingent beneficiary. So if we are looking at just naming children directly or family members directly, what happens if those family members predecease them? We make sure that it's paid out to our contingent beneficiaries, or i.e., maybe it's per stirpes down to their kids. So making sure not only that there's a primary beneficiary that's not payable to the estate, but we have updated contingent beneficiaries. This is particularly important, especially if family members experience a divorce, because if they do divorce their spouse and they don't update their beneficiaries, we've seen times where an individual or insured passes away and their ex-spouse is still named as a beneficiary, and they end up getting the proceeds, not the current spouse or the children, which they intended to. So it's just making sure that we're updating our beneficiaries and that they're applying to the aspects or the goals and objectives of the farm succession plan itself. So the other aspect is, well, what happens if we do gift a policy? So mom and dad buy a life insurance policy and they've owned it their entire lifetimes, and they decided that now they really don't need that policy to reduce a debt load or to pay a liability of the farm operation, but they want it to be there for the long-term estate planning of the farm succession plan. So maybe they gift that policy to their children as a part of their estate planning process. Well, if you make a gift of a life insurance policy and you die within 3 years of that gift, that policy will be pulled back and will be includable in the insured's estate. The other aspect of that is, if you're having to pay a federal estate tax on it, sorry, you got somebody coming in. If it's a part of your estate plan, or if it's a part of your estate, you have to pay the federal estate tax on that death benefit. So a lot of times what our clients will do, will try to say, okay, how do I make sure that that death benefit's not pulled back into my estate via the 3-year inclusion rule? Well, that may be, okay, let's go, whoops. Sorry, let's go back. So let's plan ahead a little bit. So if we are worried about that policy being pulled back into our estate, what are some aspects that we can do to make sure that we're not subjecting that policy to federal estate tax? Well, we could actually sell the policy for full and adequate consideration, meaning that we could go out and get what's called the interpolated terminal reserve value of the policy, and we could sell that policy, whether it's to our kids, whether it's to a trust, whatever aspect of that succession plan that we're putting in place, we could sell the policy. And if you sell the policy for full and adequate consideration, it would not be pulled back into your estate. Now, there may be a tax due on the sale of the asset, but it's better than having the full death benefit being included and subject to the federal estate tax if it's applicable. So we have to look at what's the best way to be able to transfer that policy into the trust or to your kids without having to pay a gift tax, federal estate tax, and it being pulled back into our estate. And that's really where it's important to make sure that you have the correct estate planning attorney, or your CPA is very knowledgeable with the tax laws surrounding that 3-year look back. Okay, so I mentioned earlier transfer for value rules. So when you're looking at life insurance, they really are subject to saying, okay, if I'm going to transfer a policy to a different owner, what am I getting in return? And does it cause a taxable situation for the transfer of that policy, or am I transferring that policy in exchange for a value of something? So when it's looking at like that transfer for value, it is very broadly defined in the Internal Revenue Code, meaning it's not just limited to the cash. It's, are you getting property? Are you getting rights to something? Are you getting a reciprocal promise? And what's that value worth? And is there a tax consequences to it? So that may say if mom and dad, again, they own a life insurance policy and they're going to transfer it to their son, who's their son's now an owner, to be able to buy out their sisters of the farm operation. Well, if mom and dad have been paying those premiums all those years, that transfer of that asset is worth something. So do they have to use a portion of their federal estate tax exemption to get that policy to their son? Or should their son come in and buy that life insurance policy from them so they don't have to use a portion of their exemption? So the value, the transfer for value rules are pretty important on there. There's some exclusions built into the Internal Revenue Services laws too. So where the transfer for value does not occur is if the LLC or sub S corporation owns a life insurance policy on an employee or the owner, the business can actually transfer the policy to that owner or that insured employee without a transfer for value issue. Now, if it's the employee, there may be some income tax, but there's not going to be tax on the death benefit. Where if it's just the owner, there will be no taxes due on that, but it will still be included in the owner's estate. On that aspect. So let's talk about a little bit of the solutions. Again, it's making sure that if those transfers that the transfers are made to an acceptable party. Again, the insured, the partner of the insured, a partnership on which the insured is a partner will not violate the transfer for value rule. But also you could transfer it to a corporation, which the insured is an offeror shareholder. You don't violate the transfer for value rule, because what the IRS is doing is they're simply saying, okay, there's no substantial gift because the insured is as the partner or as the owner, they're the same people. And therefore you're not violating the transfer for value rule and causing an unnecessary tax liability. But that's very important when you're looking at, implementing life insurance or giving life insurance away or moving things to a trust or to a different child, that we're not violating that transfer for value rule whatsoever. Okay. Another big one that we see a lot is the gifting of the policies on the transfer for value. But even if you avoid the transfer for value, if you gift the policy with the loan against it, a gift of the policy with an outstanding loan is going to cause a tax issue for both the transferor and the transferee, because essentially if you're gifting a policy with a loan on it, the owner, the transferor, is basically getting rid of that debt obligation. They don't have a responsibility. It's now going to the transferee. So that's actually a taxable event because you're forgiving yourself from the debt obligation back to the policy. And so when you're looking at that, you got to consider, okay, do I pay the loan off prior to transferring the policy? Or do I consider delaying the transfer until a later point in time? Or do I consider surrendering the policy or reducing or taking a reduction in the death benefit to pay the loan off, which there's portions of doing that. A lot of people or agents will talk about, well, just 1035 it into a new policy. And a 1035 is essentially doing a tax-free exchange from one policy to another. But if you do a 1035 as a part of paying down a loan, that's going to cause what's called boot. It's an unrecognizable taxable benefit because you're usually forgiving a loan without actually paying it down. And so that's unrecognized income that you have to pay income tax on. So we really need to be careful when we're talking about, okay, if the life insurance policy has a loan on it and we need to transfer it for our estate planning or succession planning purposes, more than likely it's better to pay that loan off before transferring or considering that transfer. Okay. The biggest issue that we see a lot of clients getting into is just failing to conduct reviews and educating themselves on the insurance product itself. Because what we recognize is a lot of our clients truly don't understand what they're buying. What products are they buying? They simply think, well, if I'm paying the premium, that policy is going to be in force. The problem is there's lots of different products that are manufactured by insurance companies today. There's variable universal life, there's index universal life, there's whole life, and there's term. And a lot of people understand what term life insurance is. And term life insurance is as long as you're paying the premium and you die within that term duration, the insurance company is going to pay the death benefit. When that term period expires, you're either going to drop the policy and it'll no longer be in force, or you're going to pay a substantially higher premium because you've come to your end of your term periods. Where it comes into interesting is really, okay, on the index, universal, whole life, and variable life, you're solving to pay a premium, whether it's for cash accumulation or pay for that death benefit. But if the policy doesn't perform as expected, that death benefit might not remain in force for the entire duration of the policy. The other thing that we get into is, okay, the different riders that are on these long-term care or that are on these life insurance policies. Insurance companies have been manufacturing different riders for many years now, but what we've seen here lately is the advent of long-term care riders or chronic illness riders. And there's a substantially large difference in the marketplace today, what our farm families need to be aware of. So there's carriers out there that manufacture a true long-term care rider, and this long-term care rider is actually going to advance the death benefit to help pay for nursing home care. So for instance, if they have a $500,000 policy, they may advance 2% of that death benefit per month or $10,000 a month to pay for their care. Well, the insurance companies on a true long-term care rider, that claim is eligible on it if you lose 2 out of your 6 activities of daily living, which are eating, dressing, bathing, continence, or dementia or memory loss. If you lose 2 out of the 6, if it's temporary or permanent, you'll be able to take an advance of the death benefit to reimburse yourself for the expenses incurred. If it's a chronic illness definition on some of these life insurance policies, if you lose, it has to be a permanent loss of 2 out of the 6 activities of daily living. And a lot of people don't get into the definitions. So I always use the example. If an insured had a stroke and the doctor says, well, we expect you to be back to normal within a year, but for the next 180 days, you're going to need some home health care, or you're going to need to be some assisted living help, they would deny that claim because it's not a permanent loss. So what people don't realize is the definitions with some of these riders and the contract provisions with some of these within some of these products is very, very important, because you could not get, you may not understand every aspect of it, and therefore you could not get the benefits that you think you're paying for. Another example in the chronic illness rider is there's a lot of companies out there that aren't paying for, or that aren't making you pay for that rider. They simply say it's no charge until you exercise to use it. Well, once you exercise to use it, that's when they start charging for it. And in the same example, if you have a $500,000 death benefit and you think you're going to get 2% of the death benefit per year, where on a long-term care rider, you could advance the full 500,000, but if they don't make you pay for it, your true bucket may only be $300,000, and their remaining $200,000 is eaten up in fees on the backside that you weren't aware of. So I always say it's really important for the buyer to really understand the contract, and for having those individuals walk through all available products and options and carriers to make sure that they know that their premium dollars are being spent the best way. There's also guarantees and how they work. A lot of people think that, okay, if I have a no lapse guarantee rider, or I purchased a guaranteed universal life policy, that they're thinking as long as I'm making those premium payments, that death benefit's going to remain in force for my entire life. Well, what they don't tell you is if a premium is 30 days late or 60 days late, or if for some reason you don't make the full premium payment, those guarantees could go from age 100 to age 105 and drop all the way down to your early 80s or mid 80s. So it's really trying to manage the expectations, and every year treating these life insurance policies just like you would an investment portfolio, just like you would any other asset that you have on the farm operation, and pulling what's called an in-force illustration to making sure that those policies are performing as expected. One of the biggest things that we're seeing right now is if you look at the interest rate history, a lot of these policies that were bought, in the mid 80s, the late 80s, the early 90s, interest rates at that point in time were a lot higher. So they may have been saying, well, as long as this policy is paying, 5, 6, 7, 8%, you only have to pay a premium of X to keep this policy in force. But what happened? Well, when we entered the 2000s, it was a 20-year period of historically low interest rates. And that 20 years compounding of a low interest rate has had our clients getting notices saying, well, the premium that you were paying on this policy is no longer sufficient to keep the policy in force, and your premium may be doubling. And in some cases, we've seen the premiums triple. And so what we're looking at is trying to make sure that we're managing expectations for these policies to make sure that the premiums that our clients are paying, that these policies are going to be there for the long-term aspect of it. And if you did not manage that correctly or pull the in-force illustrations, which I recommend to do at least every probably 2 years to make sure that the premiums you're paying are supporting the policies in itself. So one of the biggest things that we look at is really making sure that we're treating this just as important as a life and as a review, and we're making sure that those policies are doing what the long-term performance is. Now, one of the things that's very interesting, especially as late in the marketplace, is if you have a client that is in a situation to where maybe they weren't monitoring the policies as well and their premiums have significantly increases, or maybe they just don't need the policy anymore for whatever reason. There is a marketplace out there that a lot of our farm families are finding interesting. This is a life settlement process where actually you could go in and sell the life insurance policy and get depending on the situation, you could get some or all of your premiums back for that policy. The life settlement market has developed over the last decade to where your people are buying these policies just like they would a stock or a bond. And as long as they see that there's a positive internal rate of return on the premium versus death benefit, they would sell those. So some of our farm families, rather than just walking away from some of these policies, or rather than just letting the policies lapse, we will explore selling those policies to try to get some or most of their premium dollars back for them, or applying it to other bases. So I right now want to open this up to questions or go back to other slides because I kind of went through that quickly. But what questions does that lead to have?
They all got shy.
Well, and it's a pretty in-depth topic, and I could go down the rabbit hole on some more of the internal revenue codes on it, but for this point, it was trying to stay high level in some of that. So
while you're thinking about questions, I just put into the chat the link for your credit hours if you need that. So make sure you click on that to record those. Also a reminder, if you have farm families that you've worked with, the codes for those have been in other emails, as well as if you want to request the approval of a different training program that you were at, that code has been in some other emails as well, and you can get that. If you called in and cannot get that survey link from the chat session there, please make sure that you go send me an email so that I can get that emailed to you. But try to get this done as soon as possible so that I can get everything recorded and counted and everybody stays entered in the system that way. So
And
Other
if
questions?
if they have additional questions, Heather, I mean, they have my contact information. They can always send me an email or reach out. If they have more questions, I'd be happy to answer them.
You bet. I had something as you were going through, and then you said something else, and that question just went right away as I was going. There is a question in the
Yep.
chat there.
So there are situations where life insurance is not a good tool in a farm succession plan. When we're looking at insurance, when we're analyzing insurance, you run across times where the farm family is going to pay more in premiums than what they potentially are going to get back in death benefit. So it's really looking at the aspect of saying, okay, well, is it worth the expense? And I always tell most of our farm families, if you could look at, paying, creating a sinking fund and putting those same premium dollars and investing those somewhere else and getting a just as good internal rate of return to create that sinking fund versus using life insurance, there's times where it just isn't cost effective. We were working with the farm family right now. They were in their early 70s, and there was an insurance company out there trying to sell them insurance, and it just didn't make sense. I mean, they were going to be paying more into that policy than they probably would have got back in death benefit. So it's always making sure that there's a positive internal rate of return. Regarding third-party life insurance. Clarify your questioning, Kate. Oh, okay. But yeah, so we see that a lot. We see that a lot where somebody's trying to sell somebody.
Brandon, could you repeat the question since it came just to you?
Oh, I'm sorry.
Thank you.
She's got a question regarding third-party life insurance. So not sure when she's saying third party.
You guys can unmute your microphones too and ask the questions if that makes things easier for you. Please feel free. Just so you know, we will edit the questions out, and I could actually stop the recording now.